You try a 5-minute moving average crossover on Monday, lose 3 trades, and by Tuesday, you're convinced the banks are hunting your stops. Constant strategy hopping is the actual culprit behind most blown accounts. Bouncing to new systems after every losing streak creates an endless cycle of frustration. Long-term profitability depends on aligning your approach with your actual everyday reality. A demanding day job makes scalping the 1-minute chart during a lunch break a mathematical impossibility. Forget the search for a universal best setup. Instead, audit your personal schedule, your stress tolerance, and your bankroll. This chart breaks down the 3 objective constraints of trading. First is time. You have to calculate how many uninterrupted hours you can realistically dedicate to screen monitoring. Next is capital. Evaluating your account funding determines what you can afford to lose during market drawdowns. Finally, psychology. You need to know how your decision-making reacts to consecutive financial losses. We are going to evaluate the 4 primary Forex strategies strictly through these 3 variables to uncover your specific mathematical match. Scalping is a high-frequency approach. You live on the 1-minute and 5-minute charts, aiming to capture tiny 5 to 10 pip movements dozens of times a day. It requires up to 8 hours of intense daily focus, lightning-fast reflexes, and the emotional detachment to take 20 or 30 trades in a single session. The broker's spread, the hidden cost between the buy and sell price, is the primary obstacle for every scalper. This chart shows a standard 5-pip profit target. A 1.5 pip spread consumes 30% of your potential profit before the trade even begins. Operating in a 0.0 spread environment, like the one offered by FXNX, makes this high-frequency approach structurally viable. Cautionary: scalping rewards the time-rich and emotionless, but it reliably destroys the accounts of stressed, busy professionals. Day traders hold positions for a few hours and close everything before the market sleeps, removing the risk of overnight price gaps. This timeline highlights the time constraint. You need 2 to 4 hours of dedicated monitoring during high liquidity windows, like the London-New York overlap. The strategy relies on a 1-to-2 risk-to-reward ratio. This math ensures your winning trades stay ahead of your losers over the long term. Overtrading is the major psychological pitfall here. Forcing entries when the market is moving sideways quickly erodes your capital. Day trading suits those with specific daily free time and the sniper-like discipline to wait for a high-probability setup. Swing trading is the ideal mathematical match for anyone balancing a 9-to-5 job and family life. Shifting your analysis to the 4-hour and daily charts reduces your necessary screen time to mere minutes a day. You're hunting for much larger market shifts of 70 to 140 pips over several days or weeks. Holding a position past the daily market close introduces swap fees, the interest paid or earned for keeping the trade open overnight. As this chart demonstrates, terrifying 10-pip intraday drops are barely visible flickers when leaned on a swing trader's daily trendline. This style trades daily screen time for patience, requiring you to survive weekend gaps without panic. Position trading represents the investing side of Forex. Chart patterns take a backseat to massive global macroeconomic shifts. Traders in this category capitalize on the interest rate disparities between massive global economies over the span of months or years. Aggressive rate changes from the United States Federal Reserve create the fundamental momentum behind 3,000 pip trends. Position traders analyze the friction between those Fed hikes and the zero-rate policies maintained by institutions like the Bank of Japan. Capturing a 2,000 pip wave requires significant capital. Your account must be large enough to weather a 200 pip drawdown without triggering a margin call. Position trading offers high returns for minimal daily effort, provided you have the cash reserves to survive deep pullbacks. We can now synthesize these data points. Answer the 3 constraint questions to find your specific match on this decision tree. First, the capital test. Is your account funded over $5,000, or are you starting with a smaller balance? Next, the time test. Do you have a demanding 9-to-5, or can you dedicate several hours to a specific market session? Finally, the psychology test. Does a sudden $50 loss ruin your afternoon, or can you remain patient through market volatility? High capital, low screen time, and deep patience lead directly to position trading. Average capital, a rigid work schedule, and a patient mindset result in swing trading. Dedicated daily screen time, moderate capital, and controlled stress responses match with day trading. Extreme discipline, intense focus, and zero-spread broker access are the requirements for scalping. Profitability comes from accepting the system your life constraints demand. Most intermediate traders quit a viable strategy right before market variance swings back in their favor. Choose your matched strategy and commit to executing exactly 100 trades. Record your data on an institutional-grade platform like NX1. This ensures that broker slippage doesn't skew your results. Professional trading requires finding a rhythm, respecting your constraints, and flawlessly executing your edge.